I read the news so that you don't have to. Did you know that after 2008, banks didn't stop taking risks, they just outsourced them? Oh, and now those risks are quietly stacking up in the shadows again. As you can see, the headline says, banks soaring exposure to trading firms creating inherent fragility, warns S&P. Come in, let me tell you what's going on. So, according to S&P Global Ratings, banks are now massively exposed to hedge fund and trading firms. We're talking firms like Jane Street, Citadel Securities, Hudson River Trading. These aren't your typical banks. They are high-speed, algorithm-driven trading machines. So instead of taking risks directly, banks are now making money by financing these firms. After the 2008 crisis, banks were heavily restricted from making risky bets themselves. So what did? They pivoted. Instead of gambling themselves, they lend money to hedge funds who gamble for them. This is called prime brokerage. Basically, they're like, here's some billions, go trade with it. And the numbers behind all of this are really wild. Hedge fund borrowing has hit $2.5 trillion. It's doubled in just 4 years. 4 major banks, Goldman Sachs, BNP Paribas, Barclays, and Morgan Stanley, made $25 billion from this in 1 year. Basically, this is big business, but there is a problem. These banks are often highly leveraged, and banks are exposed if things go wrong. So if a hedge fund blows up, the bank doesn't just shrug, it gets hit. And because this exposure is concentrated in a handful of big banks, you've basically got a system where a few players are holding a lot of risk. So this is what S&P are basically warning about. They are saying that the system has become inherently fragile. Why? Because of something called tail risk. Low probability but high impact events. Basically, it works perfectly until it really doesn't. So when trades go wrong, banks may have to pull funding, hedge funds are forced to sell assets, prices crash, and suddenly you've got a chain reaction. Sounds familiar? Because that playbook sounds a lot like 2008 energy. It's just with a different structure. Back then, banks took the risk directly. Right now, they're financing the risk. Same danger, different packaging. So the question is, have we actually made the financial system safer or just a little bit more complicated?